Andrew, it's awesome to have you on the Bainbridge podcast. Thanks for joining.
My pleasure. Thanks for having me.
So, Andrew, your background is incredible in ecom. You got started in ecom like almost right away. It looks like you did one brief sojourn into Teach for America. And you've had a lot of different roles at a lot of different types of companies. So you have this incredible experience, across the breadth of the space, both in types of companies and experiences and roles, but also time. And now you're a VC at Irreverent. So I think it's like a really interesting journey. I'd love to kind of hear how you got started, what attracted you to ecom, and then ultimately to venture capital.
Yeah, sure. I studied economics in undergrad. I also studied psychology. Both my parents are psychologists, which is why I'm the way I am, good and bad, I guess. But really loved the elements of economics and rational or even irrational, but just the idea of trade-offs and things like that. I actually really loved like behavioral economics. Read a lot of like Cass Sunstein, a lot of Thaler, Dan Ariely, and so really loved like the application of economics combined with psychology. So after I graduated, I went to Brandeis, and then after I graduated, I got a job in digital marketing. Those were the roles that I was like interviewing for at the time that appealed to me. Ended up working at a company called Smart Sign. Smart Sign was like a Amazon of street signs. They sold street signs, stop signs, no parking signs to small municipalities, to apartment building owners, a little bit consumer, but mostly kind of that B2B. And most of their revenue and traffic was driven from repeat customers, but also all the new customer acquisition was digital and through paid search and through Google and through Bing paid search. And so started there, learned everything about paid search. Actually, they got me this like giant book. It was like a 300-page book. That's 2010, 2011. This is how people were learning the world of paid search at the time. That I used to like read on the subway on the way there and the way back.
Yeah.
Really fell in love with the discipline, the idea of the immediate feedback loop and scorecard that you got every day, the ability to make tweaks and see the performance adjustments. And then I've always, again, good or bad, but been attracted to trying to be as close to that revenue point as possible, revenue generation side. I think that there's a lot of value that comes from that. And so after that, I worked at a company called Quidsy. Quidsy was an Amazon subsidiary. I joined shortly after they were acquired by Amazon.
Yeah.
And there, I ran digital customer acquisition for diapers.com, which was their flagship site, and for wag.com, their pet site.
Yeah.
And there learned just breadth of additional channels, comparison shopping engines, affiliate. And at Quidsy, they were really big on customer lifetime value, right? So they were okay acquiring a customer for, making up numbers at this point, but for $100, knowing that customer would, over their 3-4 year lifetime, spend hundreds of dollars and make up more than that in gross margin dollars over the course of the lifetime, because these were consumable goods that were sticky and the customer service was excellent, the pricing was excellent, the experience and customer experience was excellent. So they were really focused on that customer LTV. After that, I went over and worked at the Vitamin Shop. There, I ran digital customer acquisition for their $100 million ecom biz. They also had about a little under 1,000 stores nationwide, doing $1 billion a year in annual revenue, roughly. And yeah, that was also really, really interesting, exciting. One of the big lessons there was they were really great at tying like online and offline data together. They were fantastic. I think it was like 70% plus customers who checked out in store used like a loyalty, a phone number or something, which again, 2012, 2013, 2014, pretty impressive at the time. They had a really good loyalty program, perks and benefits and discounts and everything else. And the store associates and managers were really big on it. And it really helped tie that online and offline experience together in terms of for us on the digital side to have that cohesive view of customers who shop cross-channel. And those customers who shop cross-channel were a lot more valuable. Obviously, there's correlation, not necessarily causation, but there was some causation if you can get customers to kind of do both and know that, need ran out of protein powder. I need to go to the store today. Or, oh, okay, I'm signed up for their emails. They're having a promotion on this new brand that I haven't tried. Let me test it out. I know that, I know if I don't like it, I can bring it back to the store even. I don't even need to ship it back. If I don't like the taste, I can bring it back to the store. That's how good the customer experience was. If you can get folks to have that holistic, customer view for us and customer experience for them where it was cohesive, there's a lot of value created in that. And then in the end of 2014, beginning of 2015, co-founded an agency called Agency Within, which is now called Within. We grew it with a co-founder to be one of, if not the largest independent digital marketing agency in the U.S. Worked with enterprise brands like Nike, Intuit, Shake Shack, Spanx, Etsy, and then startup brands like Goop, Rothy's, Helix, Bandier, Billy, Zola, Lola, Petflow, Trade Coffee, Twillery, and others. And, we're very fortunate, timing-wise, location-wise, with the proliferation of D2C brands, proliferation of advertising on Facebook, to be able to grow that business to 100-plus clients, 100-plus employees. Like I mentioned, one of the largest independent DMAs in the U.S. based on annual spend under management. I had a successful exit from the agency in 2018. And then after that, when I was trying to, I did the whole semi-retired thing, stayed at home, played a lot of golf and tennis. My wife was, after a certain point, like, you gotta, do something else with your life. Picked up my head, realized, all right, let me go out there, see what's going on in the world. Did the 100 coffee meetings with friends of friends, former colleagues, former just partners in the business and things like that I'd worked with, and realized the passion that I had in the digital marketing e-commerce landscape was still there, but I really loved the passion of working with those early stage startups, and really with founders and founding teams. There's just something about working with founders that just really struck a chord with me as a former founder, as a entrepreneur, as the son of entrepreneurs. My parents, like I mentioned, psychologists. My dad had his own practice. My mom had a real estate business that her parents had started that she continued to, grow and develop. So that entrepreneurship was, in the blood. And so really resonated with founders. So started to just get more involved in the early stage space, from 2019, beginning of 2019 to the end of 2021. Angel invested in 25 companies directly, advised a few companies as well, made some investments in SPVs. In addition to that, just learned a lot about the ecosystem. I was pre-COVID taking the subway in every morning, would read all the rags, all the 10, 15 newsletters that I've subscribed to, would read every single day on the way in. Send out articles to people, get their opinion, like, oh, is this, what are your thoughts on this? Or, this looks like some, business you could partner with, and really just use that to, have those conversations, gain a real foothold in the industry and start to understand, how things operated. And then was going into the city, into Manhattan, 3-4 days a week, and would stay after 2 days a week and go to the happy hours, go to the pitch competitions, go to the events, meet people, and just have a great experience of, being part of that New York City ecosystem. So that was how I made that transition from marketing agency to really start to learn even more about startups intimately.
How long did that transition take? When you first started doing Angel to setting up Irrvrnt as a your full-time gig?
Yeah, so it's a great question. I think it was a slow transition in terms of time, but it was kind of just building blocks. So at the beginning, all in, I'd say it took about 2.5 years or so. At the beginning, as I was angel investing, I was investing my own capital. At a certain point in time, I started to send deals that I was seeing that I liked to friends and folks that I met in the ecosystem, to the point where there were times where I sent deals to folks and they're like, oh, it's in e-com, you're investing, you believe in it. Like, I don't need to do my own diligence. I'm just following on your diligence.
Wow.
There was a time when that happened, where I started to realize, okay, people are trusting me because of my track record, my background, my ability to diligence and add value. I could potentially go out and raise a fund and I'm really enjoying this and want to be doing this because the fund's a really long-term commitment.
Right.
Fund itself is 10-year commitments, but going out and starting a firm that's built around multiple series of funds is a real commitment. So start to realize that this is what I want to do long term. I actually try to have some formal or informal interviews for some roles at funds. Nothing really lined up and worked out. So just went out, was like, all right, I can do this myself. Went out, was originally targeting a $5, $6, $7 million fund. Ended up getting an anchor investor to come in, Apple Core Holdings, and ended up raising a $9.5, $10 million fund with a 2-year deployment schedule, and about halfway through that fund right now.
Nice. Wow, that's awesome. And then it is the goal. I guess then you're going out and raising your next fund pretty soon, then, right? Because you're halfway through.
Yeah, so we'll probably start raising after I say like after like April, May, probably after Passover. So starting to think about working on the fund deck and everything else. I've started to have the informal conversations with a lot of some more institutional investors. I think one of the challenges of the first fund, good and bad, and I wouldn't change it, was I did it as a rolling fund through AngelList. The way a rolling fund works is technically every single quarter is its own fund. LPs who invest in multiple quarters are cross-collateralized. You can make minimums across quarters, and it's a little bit more complicated. And so for institutional funds, it's a little more difficult for them to do it. But for me, it was a great opportunity to like kind of crawl, walk, run. Crawl with the angel portfolio, walk with this one, and then eventually run with moving into a more institutionalized fund setup. And it was great also because I got to meet LPs along the way. That's a really great thing about the rolling funds, is that if you meet an LP in the third quarter or fifth quarter of your fund life cycle, in a typical fund, if you're stuck there, you might have already had your final close. You might be like, all right, let's stay in touch with the next fund. Maybe you do, maybe you don't. Here it's okay. You want to come in, you could come in right now, and had the opportunity to have some large LPs come in even kind of mid-fund, which you wouldn't be able to in a traditional fund model. And those LPs will hopefully continue with me into fund two.
So does cross collateral mean that if I were to invest in the first quarter and somebody invested in the third quarter, we still have exposure to all the investments, or what does that mean?
No, so you LPs who invest in a quarter or multiple quarters, they have exposure only to the quarters that they're invested in.
I see.
But they're cross-collateralized, so just use really easy numbers. Let's say they invested $100,000 across 4 quarters, so $25K into 4 quarters. If we had an exit from the fourth quarter, and that was the first, and we haven't had exits or liquidity events from any of the other quarters, their principal needs to be paid back in full before carry gets calculated. So they would need to get paid back not just the $25K for that quarter, but the other $75K for the other quarters. So they would need to get back their full $100K. Let's say there's $200K of value created, they'll get back their $100K. Then that additional $100K would be subject to carry, to the 20% carry.
Got it. And then, okay, so like as you get more successful and bigger, you can the terms start changing more in your favor, and I would imagine.
For in terms of,
well, like I guess actually, if you move off of a rolling fund, then it doesn't matter. You're sort of going to a committed fund, and then everybody just puts in, and you get what you get in terms of management fees and carry and things like that.
Yeah, no. So the rolling fund is like, I think probably, if I had to say, probably like a little bit worse for LPs. I mean, for a lot of the more larger LPs, institutional style LPs, like my anchor LP, they're in for the entire 8 quarters. So it almost acts like a traditional fund for them. There's some elements of the rolling fund that are a little difficult in terms of timing and other things. Traditional funds slightly better, I think, for LPs, and certainly more traditional and more accepted, and just easier. You don't have to deal with the questions for a lot of my investors in the first fund. It was their first time investing in venture, so forget about explaining rolling fund versus traditional fund to them. I was explaining carry and and power law returns and things like that to them, which I'm always happy to have those conversations with folks. Those are always exciting. I coined the term with someone else, emerging LPs. That you know, I think we're going to see less of that for the next year or two, but certainly from 2018 to 2021 or so, there were a bunch of emerging LPs, folks who were making a lot of money in the stock market and real estate and other areas that were starting to, from their own exits and in their own, traditional, SMBs or even, venture, or they were employees other places that start to want exposure to venture, and we're
Yeah.
starting to lean in on that space. I think we'll probably see a little bit less of that over the next few years as the economy has cooled, but it's certainly a place where I'm very comfortable having conversations with folks,
Yeah.
just to educate them.
No, you started. Well, when did you start first doing your angel investments? Was that 2018 or 2019? I'm sorry, I missed that.
Is tail end of 2018 is when I started to go and meet with folks and get exposure to space, go to events, start to understand more about the space. Started making investments at the beginning of 2019. So it took about 3-4 months to get comfortable. I think I probably committed to my first 2 deals in like February 2019. My first few deals have done pretty well. First 3 were that I did all of that at the same time were Lunchbox, Branch Furniture, and Caraway, which have all done pretty well. So some good, nice beginner's luck there.
That's awesome. And has your thesis changed? I mean, when you started, were you like, oh, I'm going to invest in brands, or it's expanded to,
Yeah, I think I always wanted to invest in kind of brands, ad tech, and then e-com enablement tools, infrastructure. I actually started to shy away from brands even before I moved to the fund. Even before I moved to the fund, my last investment in a brand was probably in at the tail end of 2019, beginning of 2020, really. I started to see, with rising valuations at the early stages, at the late stages, impacting the early stages, companies raising, pre-product, pre-revenue at $8 to $10 million when they hadn't even launched a product yet was tough. Seeing just from some of the brands I worked with that were having a lot of success on the revenue side, how hard that is to actually get and flow through to EBITDA, and how capital intensive some of these businesses were, right? Yes, there's debt financing and funding and all these other things going on in the space, but I think started to realize that as I was moving towards thinking more like a fund manager than an angel investor, that there's not those same opportunities for for the 5x opportunities, 10x opportunities that you can have as an angel. And listen, if you can get a 5 or 10x, you do that all day, every day. But if that's kind of the upside on the opportunity, it becomes a lot more challenging from a fund perspective. I remember meeting with the brand like in the crib space, and they're raising at 10 million pre-money, 10 million before they had even produced a product or revenue, and they were talking about, okay, and then we're talking and hit this milestone, that, and then like, yeah, and then we exit for like 100 million. I'm like, yeah, if you could 10x my money, amazing. But if that's the like upside opportunity, for a fund that's like making 20, 25 investments, it's like it does a 10x is great. It doesn't move the needle in the way that you need it to. If that's a home run grand slam for you,
right?
It's great for founders. It's good for early investors. It's good for angels. But for a fund manager, it's just not. It's just not the same.
So what? There's this the sort of conventional wisdom about VCs got disillusioned with brands, and well, who do you think is the investor for brands now? I mean, is there any VC that's set up to with a fund that would work at 10x max returns, or do you think it's like, oh no, it's just like individual investor that have to support these brands? Like what, or is it not institutional at all?
I think it's going to be, challenging for some of these brands. I look at some of the brands. I mean, I'll give an example. I also serve as fractional CMO at Twillery. It's a men's clothing company. I've worked with them at the agency for a long time, and then I've been working with them in this capacity for about 2-3 years now. And listen, they've raised very little money, outside money. They've funded, self-funded a lot, quote unquote bootstrapped, line of credits, things like that. And yeah, they're fortunate, that the founders are, older and a little bit more established to be able to do some of those things. But like, they have an opportunity where they're now in control of their own destiny, right? They're deciding, how much you want to grow, how profitable do you want to be? Do you want to focus on growth? Do we want to focus on this? Because they don't need that, $500 million exit to get out from underneath a preference stack. They need, whatever it is, $100 million would be, fantastic, right? So like, and they're growing. They can get there. It's in in sight. And so I think like that's the um, that's the challenge for these brands is are you really creating something where you could have this upside opportunity where you really can build a real generational brand. I mean, you look at some of these brands. Listen, there's a lot of you know luxury brands that have built to huge opportunities. LVMH is incredible conglomerate, and they're buying more brands in the space. There's Prime with with Jake Paul and KSI that they're building, and they're they do 500 million, $1 billion in revenue this year, right? So there are those crazy outside opportunities, but you also have to think about like how much are these brands really going to be worth at exit, right? And so I spoke to a fund recently called Listen Ventures, and Jeff there, the founder of GP there, is he understands the space intimately, and like that's all they do, and they have a very different model. It's very concentrated. They take a big stake in these brands, but they're not underwriting $1 billion exits. They're underwriting $100 million exits, and so that's if you just have to understand where the upside opportunity is as a founder, and maybe you do want to control your own destiny, and maybe you do want to get a little bit farther along, and maybe it does take more time. Maybe instead of raising capital, in year one or year two, you wait till year three till you're at $1 million, $2 million a year in revenue run rate, and then you're raising at a reasonable valuation, and the goal is really to growth, and maybe that is the last round you ever raise, right. And the goal, and you're transparent. Hey, like we're gonna get this to $10 million and then sell, or we're gonna get this to $30-40 million and then sell, or $30-40 million and then we're gonna just distribute profits, or whatever the case is, or we're gonna get to $30-40 million and then we're gonna take some debt and buy some other companies and expand the product line. But there's no right or wrong way necessarily to grow a business, but VC is not necessarily the best, catalyst and funding mechanism for everyone.
Yeah. Well, what you said something really interesting. You started with like LVMH, right? So like I hear that and I'm like, well, those brands were multi-generation builds. Like some of the brands under there have been
right.
around for 50
for a really long time. That's
right. So what do you think
Polaroid is coming up on its 10th year, right?
Is it
they
really?
Survive, they grind. Yeah, they grind. They survive. And again, like it's a process that like not everyone is necessarily patient enough these days to be that have that low and slow growth mentality. It's hard. It's challenging. I'm not going to say it's easy. I'm not going to say that they're necessarily going to get exactly everything that they want, but they're in a really good spot because they've been thoughtful about their growth along the way.
Yeah. So if you were talking to a brand, I know this is a hard question, but if you're talking to a founder now and you were saying, hey, if you're thinking of building a brand, you assume you're not going to take VC money, at least not in the beginning. How many years do you think it is before you've kind of got to Twillery's like, okay, I can control my destiny?
I mean, it could be in year one, right? It could be in year one if you stay lean and mean and you have, product and everything that works and unit economics that work, and you don't get over your skis and say, hey, like, oh, we know what our LTV is going to be in year 5 and we could spend up to this. More and more you need to really start focusing on payback period more than LTV, right? Mm-hmm. And thinking about, I was at an event the other night and one of the founders was talking to me about like their supposed 5 year LTV. I'm like, no one wants to hear that anymore. I was just direct with him. No one wants to hear that anymore. It's about your payback period. I'm like,
Mhm.
think about 5 year LTV. Money costs 10-15% nowadays, or year 3, 4, and 5 LTV is worthless,
Right.
at the time value of money. So you really got to look at, okay, we're paying X to acquire a company. We know that our payback period is 6 months or 9 months or 12 months. Okay, those
Right.
are reasonable for consumer companies. How correct you are on some of those assumptions, what those kind of cohorts look like, you gotta be constantly updating and figuring out, especially as you scale. You see a lot of companies that are acquiring $200, 200 customers a month. Their cohorts look nice. They start to scale to 1,000 customers a month. Those cohorts start to look a lot more flaky, just because as you expand your marketing, as more customers come through paid channels, as you go more upper funnel, you get people who are a little farther away from the brand. Those people aren't going to be as sticky and as high value as your best core customers who are finding you
Right.
other ways, or finding you through a friend, or coming to you organically, or you didn't really have to market to that much. And so, yeah, I mean, in terms of controlling your own destiny, could in theory be year one if you're really running lean and mean.
You, I love that you're talking about kind of like the rising CACs as you move further out into the TAM, or away from the easy or low hanging fruit. I mean, you built your career in performance and customer acquisition. Like, how do you measure that? How do you know how quickly you're kind of getting into the, man, maybe it's not worth the incremental dollar here to try to acquire this customer. We're too far away from our
Yeah,
goal.
I mean, I think you need to measure it, right? So having a really tight, you know, there's a lot. There's attribution, incrementality, marginality, right? When you talk about these things, so attribution is, okay, who and which channel get credit for acquiring this customer, right? And there's no necessarily one right answer. There's a few different tools out there. I'm an investor in a company called Revenue Roll that does attribution, that helps you try to really align, which channels should get credit for acquiring this customer. That's one thing, right? Then there's um, incrementality. How incremental were those channels, right? So let's say you turned all those channels off, or that channel off, right? Would you actually drive? Would that customer come anyways, or this, kind of they were on their way through the funnel, and like you hit them on the way, on the way in, right?
Right.
And so I think that's another thing to consider, especially with some of what's going on with Google and PMAX and Facebook. And if you're not running, incrementality tests, if you're spending over 100, 150K a month on marketing, you're not thinking through the incrementality of some of these channels, and you're just taking them at face value. I'd recommend you start looking at that. And then there's marginality. And then let's say you have a good handle on attribution, you have a good handle on incrementality. When I say good handle, getting 80, 90% of the way there is probably as good as you're going to get on these. Then the next thing is marginality. As we scale these channels, what is the performance? So not looking at just the average, but looking at, okay, when we were spending 100K and we were getting 1,000 customers, that's a $100 CAC. Let's say I'm okay with a $200 CAC. Just because I spend 200K, I could get 0 new customers, and I'm still at a $200 CAC, and I can still say this channel looks good, right? But thinking about it, what is your marginal CAC? So now I spent another $100,000. If I got another 50 customers, is that a good CAC? No, that's not great, right? But your average is still going to say, oh, this channel looks good on an
Yeah.
average basis. So thinking about that as you scale out your channels, as you scale out Google, Facebook, Pinterest, Snapchat, TikTok, all these channels, direct mail, like how much more are you spending, and looking at that incremental spend against that incremental customer acquisition. And listen, nothing is perfect, and you're not going to have this super clean test, but understanding, okay, we used to spend 3K a day in this channel, now we're spending 4K. What are we getting? Okay,
Right.
yeah, maybe some things there's some seasonality week over week, and like we have a sale and promotion, but understanding, oh, okay, for the last 2 weeks we've been spending 3K a day. Now the 2 weeks after that we're spending 4K a day. Okay, we spent an extra $14,000 over those 2 weeks. what do we get? Not just looking at the averages again, because the averages are misleading.
Yeah. Do you, I mean, one thing that we hear from founders sometimes, or, and you often read about this, is like, I think people overestimate the addressable audience or TAM, and they kind of assume that they're like, oh, I could keep growing and, everybody's going to want my thing. If I just advertise well enough or find a new channel, I can do that.
Yeah.
Do you, and then I think what happens in that case is then the founders get focused on doing that, right? I got to get more budget. I got to, growing out there, and then they can get themselves in a lot of trouble because their payback periods get way extended. They're making decisions on CAC, assuming a 5-year LTV,
Yeah.
and then all of a sudden it's like, holy shit, I don't have any money. So, like, how would you advise a founder to think through that?
Yeah, I've seen this a lot. I'm not gonna, mention names. I mean, I'm sure, I have companies I've worked with personally that have been guilty of this. I have companies, in my portfolio, other ones. I remember talking to a founder of a company, that he's like, yeah, we were this media darling. We were one of these early D2C companies. We're doing, tens of millions of dollars a year in revenue, and like, look up after like 5 years, it's like we produce $0 in EBITDA, because all we do is we take VC money, we put it onto Facebook and Google, we buy customers, and then rinse and repeat and rinse and repeat. And yeah, our revenue is going up, but that's only because we keep spending more and more money on marketing. So I think it's important to understand, like, how realistic are those LTV numbers and those payback periods, like we talked about. Like, having a 5-year LTV, great to think about, in theory, but just think about yourself. What products are you still buying 5 years later?
Yeah.
I mean, listen, I'll tell you, like, one brand I personally like, love and shop a lot for me, which is like literally like once or twice a year, is like Lululemon. Like, I'll probably buy like two, new pair of Lululemon pants and shorts, like literally like once a year. My 5-year LTV for them is not that high. Again, you got to look at the time value of money, right? Yeah, they acquired me, however many years ago, and like I keep paying dividends and whatever. But again, like, that the dollars up front are worth so much more than dollars in the long run, especially in this environment. So, yeah, TAM for a lot of these consumer companies is everyone in the U.S. or 50 million people or whatever.
Right.
But look at some of the big brands in your space and see how much have they been able to capture. And how have they captured it? Has it been by going, through distribution, through, through wholesale, through Costco or grocery stores or whatever the channel is that makes sense for your brand and your category? Or is it, hey, we're going to disrupt and we're going to spend money online and we're going to acquire customers that way? Like, you're just paying another middleman. That middleman is Google or Facebook
Right.
or the marketing channel. So, a lot of stores, a lot of these brands opened up a bunch of stores. Now they're closing a bunch of stores. They thought stores were going to be the answer. I think it's really understanding that, your customer base of customers that you could acquire at a reasonable CAC might not be as large as you once thought. And also, like, just stay alive and grow, and you don't need to necessarily continue to grow at these astronomical rates. Again, if you can control your own destiny a little bit, and just continue to grow and survive. And then, what happens? Those customers that you paid for in year 1 and year 2, they start to come back, and that starts to be, that EBITDA that you get that you really weren't accounting for, and like you're running marketing at break even, and now all these repeat customers from the first 2-3 years start coming back, and that's when you start to see like those things really compound, and that revenue really starts to stack. Because, okay, yeah, we're spending money on these customers, trying to break even 3, 6, 9 months, 12 months, and we aren't doing that on the marketing side, and like, and then we have all these previous customer revenue come back, and those are paying for our SG&A costs, and also, by the way, they're going above and beyond, and wow, actually we made money last month, and like,
Yeah.
get that in our P&L. That's something nice to kind of see in there.
The cash went up. Oh my God. So you mentioned payback period. I love it. You still hear a lot of people talking about like running their campaigns off of like ROAS, or which I think they really just mean sales, and or like MERS? Like, what do you think is how do you think about the metrics of customer acquisition and ad spend?
It's challenging in this environment. CPMs are higher than ever before, although maybe not than ever before. It'll come down a little bit, but you really again have to. I think one of the big mistakes, I was auditing a company recently, and one of the things that I saw there was like this disconnect between like kind of what was happening at the C-suite level and what everyone was understanding, and then this is a temporary tattoo for anyone who's curious. My daughter's birthday was on Tuesday, and was giving all the kids tattoos. She wanted me to get a tattoo. I was like, all right, I'll put this little one on. I just needed a disclaimer there. I'm Orthodox Jew. I wouldn't put on a tattoo. Not that I have anything against tattoos personally. There was this like big disconnect in my mind between kind of what was happening at the C-suite level and then what was happening boots on the ground at the execution level. Right? Like they were talking about, hitting these revenue targets. They're talking about, again, these like average CACs and payback periods, but there isn't that like deeper connection and like, I don't want to say trust, but like then combination trust understanding where you can be like, listen, like we're going to make these changes in the platforms and the metrics in the platforms might not look good. But the reason for that, and I'll give a concrete example here. Google used to have smart shopping for said shopping campaign, for said product listing ads, and they had shopping campaigns, and they had smart shopping campaigns. Now they have Performance Max. And with one of the big changes in Performance Max was, by the way, you can't layer in audiences. Now a recent change in Performance Max is you could bid differently for new customers and repeat customers, or just exclusively target new customers. And so what I see is a lot of companies not making that change to only target new customers. I'm like, listen, you don't know how much of the revenue and how much of the conversions coming through this channel are repeat customer revenue. So it might not be a lot of your spend, but again, going back, it's inflating that metric, the average ROAS that you're seeing, or the average CAC that you're seeing, because you're counting those conversions of new customers. So for example, you might be spending $10,000 here, getting $50,000 in revenue, and be like, great, we're at a 5x return on ad spend. That's amazing. $1,000 of that spend might be driving $20,000 of repeat customer revenue, and really what you should be doing is discounting it or not counting it at all, and being like, listen, like that revenue, okay, like yes, we want it, we're happy to get it, but that's repeat customer revenue. We already paid 3, 6, 9 months ago to acquire that customer. We baked in their LTV. We can't pay for it again. I can't keep paying for customers to come back in. Or if I am, I at least need to account for that, right? By the way, we're really spending $9K and driving $30K revenue. That still might be good, but it's not the same as 10 and 50, and understanding that. And so that's like some of the conversations that I'm seeing and happening across a few different brands here is understanding that there needs to be between C-suite execution, whether it's agency, internal, that understanding of like what we can actually do boots on the ground to account for some of these things, and how do we create, hopefully you can even create, for brands that are spending serious money like that brand, like really have a deep understanding of hey, these customers, having CDP set up, having your pixel set up in a way that actually passes back information in terms of predictive LTV. At a minimum, hey, is this a new customer, repeat customer? Oh, we only want to fire the pixel if it's a new customer. Or, oh, okay, if it's a repeat customer, take the revenue and only take 10% of the revenue as revenue, because that's the value we would pay for to drive a repeat customer. And so you got to get more sophisticated as you scale up, because it makes sense. Again, when you're spending 100, 150K, that's when you start to think about going back to it. You should be thinking about payback periods from the beginning, then attribution, incrementality, marginality, then start to think about new customer, repeat customer, especially as your brand gets older and as you scale up, all these repeat customers coming back through some of these channels, making sure that you're looking at the performance of those repeat customers separately, or if you're accounting for them in some way, thinking through actually passing back and setting up systems to pass back predictive LTV actually at the point of conversion, at the point of customer acquisition.
And I mean, that's fascinating because, as you were talking, I was like, what is the relationship between your cohorts, right? So you're saying like, oh, I've got these customers and like they're coming back, but what's the relationship between them coming back and your ad spend? And you're saying, is it like kind of an 80% thing? You can probably get an 80% answer, but it's better to try than
Yeah, I mean,
ignore it altogether.
try to get, yeah, if you could get 89% of the way there, you're in a good spot. I mean, for example, again, I'll just go back to Twitter. Like we look at how much we're spending on, like retention marketing and brand marketing, and think through that, and in some ways allocate that to like this repeat customer, trend. So like, all right, great, these customers are bringing back, and this is what their LTV is. But like, what's their LTV? What's their LTV in terms of revenue? What's their LTV in terms of gross profit margin? What's their LTV after you account for returns and everything else? What's their LTV gross profit dollars after you account for CAC? What's their LTV gross profit dollars after you account for CAC and if you account for any retention marketing dollars that you put in
Right.
for customers? And that's really how you want to, again, this is a mature business. It's been around for 10 years. But, that's how you want to get to. And again, it's not about getting to perfection. It's about getting 89% of the way there so that you can allocate your dollars the best places possible, right?
Yeah.
The goal is not to have this nice, pretty report that says X, Y, Z. The goal is, okay, this is what's happening. And these are the adjustments we're going to make based on that. And
Right.
this is how much we're allowed to spend in these channels based on what we're actually seeing. And let's update this monthly or quarterly or whatever the case and cadence that makes sense for your business as you're growing.
Yeah. And who owns that? It sounds like you own that at Twillery, but is that often in marketing or is that the CEO or finance or who typically?
Yeah, I think it's probably, yeah, it's not that's probably like a CMO type thing. And I think like, one of the trends that I saw on the CMO side for the past few years that I think you're seeing revert is it was very brand heavy. And I'm not a brand person, and I'm not disparaging brand in any way. It's wildly important, that's how come you're able to charge. That's how, you know, LVMH is able to charge what they charge for
Right.
bags that are, yes, they're great, but their margins are, insane. They're charging a couple $1,000s for bags that cost a couple $100s to make. But I think having someone who understands, understands analytics and understands the channels and that where you're deploying most of your dollars is widely important to have someone with that purview, in the C-suite.
Yeah. Andrew, switching gears, tell me what you're looking at now. For you have half your fund to deploy. You're obviously going to go out and raise more. Like, what are the things that you're looking for?
Yeah, areas that I'm really excited about are e-commerce enablement, commerce tech, marketplaces, ad tech, places that really help these brands, whether they're startups or older brands, more traditional brands, start to drive more GMV, more revenue. Um, Examples of that include companies like Maple. What they do is they help brands that are in the U.S. Get live internationally. They work with Euphorics and a few other like CPG and beverage and makeup brands. They enable you to basically have like 2-3 day shipping internationally, priced really competitively. One thing that I love about what they're building is they're also building a space where there's already demand. A lot of these brands already have 15-20% of their traffic is international. They don't have a real way to serve it, a real good way to serve it. So they're stepping in and meeting that demand. Recently invested in a company called Skipty. What they do is they power rental, running a test right now with about 20 stores for Home Depot. And again, Home Depot does about $1 billion a year in annual rental volume. Going to a place where it makes sense. Talk to Staples and Walmart. Staples complains a bunch of people rent a bunch of projectors or buy a bunch of projectors from them in the end of January, return them in the middle of February, right around the Super Bowl time. They're like, we'd rather just rent it to them. These people
Right.
don't need, new in box. They don't want to pay, a restocking fee, but they'd happily pay $20-$30 to rent a couple $100 projector, and
Right.
they don't need a brand new one, right? Guitar Center does a bunch of rental, all paper and pen. You got to call the store, go in. So trying to get a contact there, if anyone has a contact there, or if Guitar Center, C-suite, you're listening to this, give me a ping. Um, but again, this idea of like taking the assets, the revenue, the assets, the products, the stuff that you already have, and how do we get more GMV, more revenue, more profit out of these places?
Nice. So you e-com enablement obviously depends on brands being successful or more brands. Like, what's your view, here in end of February 2023 of D2C and e-com over the next 12 months?
I think it's a good opportunity to kind of stand out um, in terms of, again, if you can survive 2023 in a place where you're continue to grow or stay into kind of the same spot that you were, there's opportunities to just continue to build that brand. Again, every year you're alive, you have all those customers that you got previously who can come back and spend revenue with you. So really, how do you make sure you get to get to that stage, and then also just ideally continue to grow. Growing 5-10% month over month really does compound. So figuring out the ways to do that is that, hey, like, we need to get our AOV up. Let's figure out how to maybe offer some bundle pricing, right? Realizing, hey, maybe we have some channels that we haven't really tapped. We don't have a refer a friend program. Let's spin that up. Let's do it. It's not the most difficult thing. It's not the most costly. There's apps for it, or even just sending out emails to your customers around it and personalizing the brand and having them become become referrers is valuable. Are there ways to get on new platforms? Whether again it's wholesale, whether maybe it's not wholesale, maybe it's getting live on Amazon and spinning up Amazon and being like, listen, that's another channel that we're gonna get live. You pay for performance in terms of the revenue and everything else. Your fees are based on the revenue. There's some setup fees. Twitter, we just got live on app. We used to be live on Amazon, didn't work out so well, and now we're live again recently, and it's growing and compounding. And this is not going to be a huge channel for us in the next 6 months, but it takes time. But it can be a big channel if you expend your resources against it. So, stay alive, grow, try to get to controlling your own destiny. Think wisely about the dollars that you're spending on marketing. Are they really driving incremental gross profit dollars within a payback period of time that's acceptable relative to how much you're going to be able to raise your next time and et cetera? Yeah.
Well, that's awesome. That was you dropped a lot of gems in there. So I'm sure this will be a great episode. But thank you, Andrew. It's great having you on.
Likewise. Thanks for having me, Ben. I appreciate it.